SoFi just reported Q4 earnings and right away, the stock soared more than 20% in a single trading session. The bulls were celebrating, but unfortunately, the party was short-lived as the stock gave up pretty much all its post-earnings gains in a matter of days. So SoFi stock is back to where it started, under $8 a share, which got investors thinking, is now the time to buy the SoFi dip. So in today's video, I want to give you an update on SoFi. I'll be talking about the company's recent earnings report, valuation, and what I think about the stock moving forward. As a disclosure, I do have a position in SoFi, so do stick till the end to find out what I'll be doing with my position. As always, you can read the article version of this analysis, which I will leave the link in the description box below. And with that out of the way, let's take a look at SoFi's Q4 results. For the year, SoFi generated $2.1 billion of revenue, which is up 35% year over year, and in Q4, revenue also grew 35% year over year to $615 million, which beat analyst revenue estimates by 4%. So that's great to hear. As you can see, SoFi continues to display strong growth despite a challenging macro environment, which goes to show how well management has executed so far and how much people love SoFi products. Here we can see how revenue looks like for each segment. For the lending segment, which is SoFi's largest segment, revenue was $353 million, up by 8% year over year, driven by higher loan balances and net interest margin. But notice the major slowdown in the segment. This was due to typical seasonality as well as lower loan originations intentionally planned by management, which was $4.3 billion in Q4, but that was down by $0.8 billion from Q3. On the other hand, tech platform revenue re-accelerated in Q4, growing 13% year over year to $97 million. This was driven by strong organic growth of existing partners and new clients, which consequently led to an 11% year-over-year growth in tech platform accounts to 145 million. Moving forward, management expects the segment to continue to accelerate as the deal pipeline remains robust. And last but not least, we have the financial services segment, which recorded $139 million of revenue in Q4, up by 115% year over year, which marks the 6th consecutive quarter of triple-digit growth for the segment. And growth was mainly due to strong product adoption as well as improved monetization, with revenue per product up nearly 50% year over year to $59. So overall, really strong performance for each of the three segments, which if you haven't noticed, all produced record revenue in Q4, which is great to see. So a key driver of SoFi's growth is its expanding member base, which grew by 41% year over year to 7.5 million. On a quarter over quarter basis, SoFi added 585,000 new members in Q4, which is well above its quarterly guidance of 500,000. And I've said this numerous times, member growth is crucial because the number of members is a leading indicator of future growth. The more members there are, the more products will be used, which translates to higher revenue. So to see such strong growth in the number of members alone is a very bullish sign in my opinion. And with more members using SoFi, total product usage grew rapidly as well. In Q4, total products used was 11.1 million, which is up 41% year over year. On a sequential basis, the company added 695,000 new products, which is more than new member adds, and even despite the closure of its crypto or digital assets business. And if not for this, total product growth would have been 45% year over year, so really strong momentum in terms of product growth. And here's a metric that I like to look to track SoFi's level of monetization. So if you take total products divided by total members, you get products per member, and as you can see, products per member was 1.48 as of Q4. But here's the thing, this number is extremely low in my opinion. If you look at the company's website, SoFi has over 10 products such as personal loans, invest, credit card, insurance, and so on, and they're not even done launching new products. So the number of products could grow to 20 or even 30 in the future. So again, 1.48 products per member is very low, which means that monetization is still very low as well. But you might be wondering, why hasn't the metric improved over the last few years? Why hasn't it gone to 2 or 3 products per member? Well, that's because SoFi is still growing its member base rapidly, which tend to only use one product when they join SoFi. But as time goes by, maybe the next year they will eventually use one more product, and then the next year another product, and then the next year another product, and so on. And that's called cross-selling, which allows SoFi to gain additional product adoption at minimal cost. And for management, that's called the financial services productivity loop. But the point I want to make is that monetization is still very low, which means that SoFi's revenue potential is still very large. In fact, I think it's nowhere near its potential yet. That said, I see the potential for the average SoFi customer to adopt at least 4 or 5 products down the road, which in essence should drive meaningful growth for SoFi. But all in all, it was a very strong quarter in terms of growth. As an investor, you want to invest in companies that are led by reliable and trustworthy management, and considering management's strong execution so far, I think SoFi's future is in very good hands. Turning on to profitability, contribution profit, which is net revenue minus direct expenses, was $918 million for the year, up 70% year over year, representing a 44% contribution margin. For Q4, contribution profit was $282 million, which is a record high for the company, as you can see right here, up 55% year over year, representing a 47% contribution margin. And as you can see, margins continue to expand with each passing quarter, demonstrating economies of scale within the business. So here we can see contribution profit by segment, and as you can see, Q4 lending segment was $226 million, which is a 65% contribution profit margin, which is down 1 percentage points year over year, but this is a 5 percentage points improvement quarter over quarter, likely due to the recovery of the home loans and student loan segment, so that's great to see. Turning to tech platform, the segment had contribution profit of $31 million in Q4 at a contribution margin of 32%, which is up 12 percentage points year over year. So after several quarters of falling margins, it is now back to 30% plus margin, so it is good to see the segment regaining momentum. And finally, we have the financial services segment, which has a contribution profit of $25 million at a contribution margin of 18%, up from negative 67% year over year and 3% quarter over quarter. So the segment is demonstrating really strong operating leverage, as you can see here. As a matter of fact, operating leverage was so strong that the segment generated $74 million in incremental revenue with only $6 million in incremental direct expenses, resulting in an incremental contribution margin of 92%. That means for every dollar generated by the financial services segment, it consequently generates 92% or 92 cents of profits, which is insane to think about it. So the 18% contribution margin that you see here is nowhere near its ceiling, so expect this number to expand even more over the next few quarters and years as the segment scales further. That said, overall contribution margins keep getting better and better over time, and I expect margins to expand to 50 and even 60% in the future. In terms of the bottom line, the company generated a loss of $301 million in 2023, but in Q4, the company turned GAAP net income profitable with a net income of $48 million, representing an 8% net income margin. In addition, GAAP earnings per share was 2 cents, beating analyst estimates of $0. Adjusted EBITDA, which is a proxy for cash flow, was $432 million for the year at a 21% margin, and in Q4, adjusted EBITDA was $181 million at a 30% margin, which is basically management's long-term financial target. So to see margins jump up that much in Q4 is just crazy in my opinion. In addition, Q4 incremental adjusted EBITDA margin was 74%, meaning there's still much more room for margin expansion moving forward. In short, Q4 was an inflection point for SoFi as the company turns GAAP net income profitable for the first time. So congrats to the SoFi team for this amazing accomplishment. And because of this, I think a lot more investors, institutions, and even customers are going to take SoFi even more seriously since it is now a profitable bank. And judging by the growth and profitability momentum of the business, I don't see why profitability won't improve from here, which should drive meaningful earnings growth for years to come. So I'm excited to see how things will evolve in 2024 and beyond. Looking at the balance sheet, SoFi has a net cash position of negative $2.1 billion as of Q4, which improved by $1.4 billion quarter over quarter. So that's great to see. On a side note, SoFi also grew tangible book value for the 6th consecutive quarter by $0.2 billion quarter over quarter to $3.5 billion as of Q4. Here, we can see how its balance sheet has expanded over time, and as you can see, its loan portfolio and customer deposits has been growing over the last few quarters. As of Q4, SoFi has $23 billion of loans, adding $1.6 billion quarter over quarter, customer deposits of $18.6 billion, adding $2.9 billion quarter over quarter, which is way above its guidance of $2 billion. On the other hand, SoFi reduced its debt exposure by $1.1 billion quarter over quarter to $5.2 billion. So if you haven't noticed, deposit growth outpaced loan growth, which enabled SoFi to reduce its debt exposure, resulting in a lower cost of funding for its loans. So deposit growth is good as it enables SoFi to fund its loans at a lower cost of capital compared to issuing debt. As such, SoFi's net interest margin expanded to 6.02%, up from 5.99% quarter over quarter and 5.94% year over year. So all in all, I like how SoFi's balance sheet continues to grow, especially without substantial leverage or debt on its balance sheet. Let's now look at management's guidance. I think management gave us a lot of numbers here, so to simplify things, I will only focus on the upper end of their guidance since management always beat them anyways. So here I've compiled management's guidance into one neat table, and I've also included Q4 results for comparison. So for Q1, adjusted revenue is expected to be about $560 million, up 22% year over year, which is quite a slowdown from Q4's growth of 34%. In addition, management expects Q1 adjusted revenue to be lower than Q4's figure, which is why they're expecting a drop in adjusted EBITDA in Q1 to $120 million at a 21% adjusted EBITDA margin, which is down 900 basis points quarter over quarter. But fortunately, management expects to maintain GAAP net income profitability in Q1 with a net income of $20 million for the quarter. For the full year, management didn't give us an exact number for adjusted revenue, but they did provide us a few assumptions which are laid out in this tiny table right here, which is that lending revenue is expected to be about 95% of 2023 levels, as well as a 50-50 revenue split between the lending and the other two non-lending segments. So if we look back in 2023, lending adjusted revenue was $1.3 billion, so 95% of that would be about $1.27 billion. And since management expect 50-50 revenue split between lending and the other two segments, the tech platform and financial services segment combined is expected to generate about the same revenue as the lending segment at $1.27 billion. So if we add them all together, we get a little over $2.5 billion of revenue for SoFi for the full year of 2024, which is about a 20% growth year over year. Again, this is quite a slowdown from last year's growth of 35%. In terms of profitability, management expects an adjusted EBITDA of $590 million for the year, with adjusted EBITDA margin ramping to 30% by year end. And finally, 2024 net income is expected to be about $105 million or an earnings per share of 8 cents. In my opinion, guidance was a little soft, which is probably why the stock gave up all its post-earnings rally. But keep in mind that management is being super conservative with their guidance. First, management is expecting some sort of a recession in 2024 with GDP down for the year, a 5% plus unemployment rate, and 4 rate cuts only. Second, given macro uncertainties, management is intentionally limiting lending growth below the much higher level of demand and capacity that the company has. And third, they are assuming no significant new business launches or acquisitions in their outlook, with growth entirely coming from existing businesses. In other words, management is sandbagging their guidance in a really big way. In addition, analyst estimates are too negative as well. So in 2024, analysts are expecting only 7 cents of earnings per share in 2024 versus management's guidance of 8 cents. And for revenue, analysts expect only 15.6% growth in 2024 versus the 20% growth that I estimated earlier. So in short, management and analysts have very low expectations for SoFi in 2024. And given management's consistent track record of strong execution, I think SoFi is perfectly set up for another year of outperformance, which should drive the stock price even higher from here. Speaking of which, let's talk about valuation. As part of their long-term outlook, management projects earnings per share of 80 cents in 2026, and based on today's stock price of about $8, SoFi is basically trading at a PE ratio of 10 times its 2026 earnings, which is very cheap for high-quality, hyper-growth stock like SoFi. However, 2026 EPS estimates are too far off and thus are not very reliable. That said, let's take a look at some other valuation metrics. So based on an EV to revenue multiple, SoFi now trades at its lowest valuation multiple ever at just 4.5 times, well below its peak of 38.9 times and average of 10.6 times, so SoFi still looks relatively cheap here. In terms of price to tangible book value, which is a popular metric to value banks, SoFi trades at a ratio of 2.3 times, which is a premium compared to larger banks such as JP Morgan, Bank of America, and Wells Fargo. However, the premium is well justified given the fact that SoFi is growing much faster than these legacy banks. In my view, SoFi may even look cheap since it's growing multiple times faster than these legacy banks. In addition, management expects tangible book value growth of about 300 to 500 million in 2024, which should drive SoFi's multiple even lower from here. As for me, I have a price target of $15 for SoFi based on the assumption that SoFi generates $9.4 billion of revenue at a cash flow margin of about 21.6% by 2032. Using a perpetual growth rate of 2.5% and a discount rate of 10%, I get a price target of $15 as you can see right here. So in short, I think SoFi is significantly undervalued and I think the stock will do very well in the next year or so. To wrap up this video, Q4 was a very strong quarter for SoFi. The company posted record revenue as well as GAAP net income profitability for the first time ever, which is a huge milestone for any public company. This is a major reason why the stock rallied 20% plus following its earnings release. However, in a matter of few days, the stock gave up all its gains, probably due to weak guidance issued by management. But do understand that management is just being extra conservative. In addition, analysts are just too bearish on the stock, which sets the bar very low for SoFi in 2024. That also means that it's going to be relatively easy for SoFi to beat expectations in 2024, and when they do, I expect the stock price to move higher over time. In the meantime, the stock still trades at attractive valuations, and now that the company is GAAP profitable, I think we can expect more inflows from institutions and investors, which should drive the stock price higher as well. And as for me, I just added to my SoFi position as I'm even more bullish on the stock following its Q4 results. So that is it for today's video. Want to know what else I'm bullish on? Maybe you can click this video right here. Otherwise, thank you guys so much for watching this video. I'll see you guys on the next one.